You have a will. Maybe you paid a lawyer for it. Maybe you filled one out at a kitchen table with a pen that was running dry. Either way, you believe that document decides who gets your money. It does not. For most of what you own, the retirement account, the pension, the life insurance, the health savings account, your will decides nothing at all. There is another piece of paper, shorter, older, usually filled out in about 90 seconds, often decades ago, at a desk while somebody waited, and that paper outranks your will completely. It does not matter what your will says. It does not matter what you told your children. It does not matter what every person in your family understood to be true. The company holding your money reads one form, and it pays whoever is written on that form. Verified card. Source. Beneficiary designations on retirement accounts and insurance policies pass outside the will and control distribution, even if that name has been wrong for 30 years. Even if that person is your ex-husband. Even if that person is dead. There are 5 of these forms in the average American household. 5. And every single one of them is sitting somewhere right now with a name on it that you have not looked at since the day you wrote it. Before this is over, I'm going to tell you which of the 5 destroys the most money when it is wrong. It is not the one you are thinking of. It is not the retirement account. It is a smaller account, one that a lot of people barely think about. And getting the name wrong on it can hand a single year's tax bill to your own child that runs into 5 figures. My name is Kevin. I read the rules so you do not have to. If you are new here, this channel exists for one reason. We read the fine print that decides what happens to your money, so you find out before the system decides for you. Subscribe and turn on the bell, because every one of these 5 forms is in your house right now, and not one of them will ever remind you it exists. But before the 5, you need to understand why a form beats a will, because once you see the reason, everything after it makes sense. A will is a set of instructions to a court. You die, the will goes to probate, a judge oversees the process, and your instructions are carried out under supervision. That is what a will is. Instructions, reviewed later, by a court. A beneficiary designation is something completely different. It is a contract between you and a company. You told a bank or an insurer or a retirement plan, if I die, pay this person, and they agreed. Verified card. Source. Beneficiary designations are contractual and are honored by the account custodian regardless of will provisions. So when you die, that company does not call your lawyer. It does not read your will. It does not ask your family what you would have wanted. It opens a file, finds the last form you signed, and pays the name on it. The money is gone before probate even begins, before your will is read, before anyone in your family knows the account existed. That is why this is the quietest way in America to lose a large amount of money. Nobody argues, nobody objects. There is no fight, no hearing, no chance to explain. A clerk reads a name and sends a check. And I want you to understand why this system exists, because it is not a conspiracy. It is convenience that hardened into law. Companies wanted a fast, certain way to pay out without waiting years for probate courts. Families wanted money to reach them quickly, without a judge and without legal fees. So the beneficiary designation was built to be simple, immediate, and final. And it works beautifully when the name is right. The entire design rests on one assumption, that the person who signed the form kept it current. That is the assumption. That is the whole thing. And almost nobody in this country has ever been reminded to check. Your bank sends you a statement every month for 30 years and has never once printed the beneficiary on it. Think about how strange that is. That statement tells you your balance to the penny. It tells you the interest rate. It tells you a dozen things you will never need to know. And the one piece of information that decides who receives the entire account is the one thing it does not say. Not because anybody is hiding it, because nobody ever thought to put it there. And here's the part that makes people sit forward. Your will cannot fix it. You can write in plain language in a document your attorney drafted that everything goes to your wife. And if the retirement account form says otherwise, the retirement account does not go to your wife. Verified card. Source. A will generally cannot override a valid beneficiary designation on a contractual account. The will loses, every time. And here is what makes this so much worse than it needs to be. Think about how much attention a will gets. You make an appointment. You sit with an attorney. You think hard about your children, about fairness, about what you want to leave behind. It costs money. It takes weeks. You sign it in front of witnesses. Now think about how much attention a beneficiary form gets. It is line 11 on a page of enrollment paperwork on your third day at a new job. You are 26 years old. Somebody in human resources is waiting. You write down whoever comes to mind first. That takes 90 seconds. And 40 years later, the 90-second document beats the $1,000 one, completely, without argument. That is the imbalance at the center of this entire video. The most carefully considered document in your house governs the least of your money. Now, the 5 forms. Form 1, the retirement account, your IRA, your workplace savings plan. For most households, the largest single thing they own that is not the house. And there is a specific version of this failure that has ended marriages after death, and I want to walk it slowly because it involves a trap most people have walked straight into without knowing. If you have a workplace retirement plan, a 401k, a 403b, federal law gives your current spouse a protection. To name anyone other than your spouse as the primary beneficiary of that plan, your spouse generally has to sign a consent, in writing, usually notarized. Verified card, source, ERISA, spousal consent requirement for qualified plan beneficiary designations. That is a real, meaningful protection. It means a workplace plan cannot quietly go to someone else without your spouse knowing. Now here is the trap. An IRA does not work that way. An IRA has no spousal consent requirement. None. You can name anyone you like at any time and your spouse will never be told. Verified card, source, IRAs are not subject to the ERISA spousal consent rules that apply to qualified employer plans. So think about what happens on the single most common financial move in American retirement. You retire. You roll your workplace plan into an IRA. Everyone recommends it. More investment choices, lower fees, one statement instead of 4. It is usually good advice. But the moment that money lands in the IRA, the federal protection your spouse had over it is gone. The account did not change. The balance did not change. The protection changed. And nobody at the rollover desk says a word about it, because nobody at the rollover desk is thinking about who dies first. Ardith found this out on a Thursday. Ardith is 73. She lives in Ottumwa, Iowa. She was married to Wilbur for 31 years. Wilbur was her second husband, and she was his second wife. Both of them had a first marriage in the rearview mirror, the way a lot of people do at that age. Wilbur had a retirement account from a machine shop where he worked for 2 decades before they ever met. When he retired, he rolled it into an IRA because that is what the man at the bank suggested, and it was sensible. The beneficiary form on that old workplace plan had been filled out in the 80s. It named his first wife. When the rollover happened, the new IRA came with a new beneficiary form. Wilbur signed it in a stack of paperwork on a Tuesday afternoon. He carried the old name forward, not out of love, not out of spite, out of not reading. Wilbur died 4 years later. Ardith, who had been his wife for 31 years, who had nursed him through 2 surgeries, who was named in his will as the person who inherits everything he owned, got nothing from that account. The custodian read the form. The form said a woman Wilbur had not spoken to since the Reagan administration. The check went to her. And Ardith's lawyer told her the truth that most families in this position hear too late. There was nothing to sue over. The form was valid. Wilbur signed it. He had 31 years to change it and did not. A court is not going to rewrite a contract because the outcome was sad. Verified card. Source. Courts generally enforce valid beneficiary designations as written, even where the outcome conflicts with the decedent's apparent wishes. Now, I want to be fair here because there is a wrinkle that helps some people, and I will not hide it. Many states have laws that automatically strip an ex-spouse off a beneficiary form when a divorce is finalized. Verified card. Source. Many states have revocation upon divorce statutes affecting certain beneficiary designations. But those are state laws, and a great many retirement accounts sit under federal rules that can override what a state says, which means the answer to, "Am I protected?" is not a clean yes or no. It depends on what kind of account it is, what state you are in, and what the plan documents say. That is a terrible thing to depend on, especially when the fix is a form you can request in one phone call. And there is a piece of Ardith's story I have not told you yet, because it is the part that keeps people up at night. Wilbur was not careless with her. He was the opposite. He had a will drafted. He had a small trust. He had talked to Ardith many times about what he wanted her to have. He was, by every ordinary measure, a man who had handled his affairs. He had done 4 things right and 1 thing not at all, and the one he never did was the only one that governed the largest account he owned. That is what makes this failure so cruel. It does not punish the disorganized. It punishes the organized who missed 1 line. The people who feel most certain they are covered are exactly the people who never think to check. Form 2. And this is the one I promised you at the start, the one that does the most damage per dollar. The health savings account. If you have ever had a high-deductible health plan, you may have one of these. A lot of people do and barely think about it. It is the account you use for a dentist bill or a pair of glasses. Some people have built them up seriously. Tens of thousands of dollars, invested, growing, untouched. And it is the single most tax-advantaged account in the entire tax code. Money goes in without tax. It grows without tax. It comes out for medical costs without tax. Verified card. Source: IRS. Publication 969. Health savings accounts. 3 layers of tax protection. Nothing else in American finance does that. And here is what happens to all 3 layers the day you die. If your spouse is the named beneficiary, the account simply becomes their health savings account. Every protection continues. Nothing is lost. Verified card. Source: IRS. A surviving spouse named as HSA beneficiary may treat the HSA as their own. If anyone else is named, a child, a sibling, a friend, the account stops being a health savings account on the date of your death. Verified card. Source: IRS. Publication 969. HSA ceases to be an HSA when a non-spouse beneficiary acquires it. Not gradually, not over 10 years, on that date. And the entire value of it becomes taxable income to that person, in that single year, all at once. There is no stretching it out. There is no 10-year window like an inherited retirement account. There is no rolling it into something else. 1 year, full balance, ordinary income, on top of whatever that person already earns. Clarice had a health savings account worth about $60,000. Clarice was 70, from Sedalia, Missouri, and she had been proud of that account. She barely touched it for 15 years. She had read somewhere that it was the smartest place to leave money, and she was right about that. Her husband had passed years earlier, so on the form, she named her son. That felt obvious. He was her only child. Of course it was his. Her son is 51. He is a project manager. He earns a good living, not a fortune. The year his mother died, that $60,000 landed on his tax return as ordinary income, stacked on top of his salary. It pushed him well up into a higher bracket. Between federal and state, that inheritance cost him roughly $17,000 in tax he would never have paid if the form had been filled out differently. And here is what makes this one sting more than any other on the list. He was grieving. He had just buried his mother, and the first financial event of his grief was an unexpected tax bill for money she had spent 15 years carefully protecting from tax. Everything she built that account to avoid, it did in a single year. Now, could it have been avoided? In part, yes, and this is the whole reason I am telling you. There are choices here. Naming a spouse when you have one keeps every protection alive. Where there is no spouse, the form still matters enormously, because who is named and whether the account is handled correctly in the first year changes the outcome. Verified card. Source: HSA. Beneficiary treatment differs by spouse, non-spouse individual, and estate. There are also outstanding medical expenses that can be applied against the balance in a specific window after death, which almost no beneficiary ever knows to do. That window is short. That knowledge is not printed on any statement, and when it is missed, it does not come back. And there is one more version of this that is worse still. If no beneficiary is named on a health savings account at all, the balance generally goes to the estate. And when that happens, the value is included on the account holder's own final tax return. Verified card. Source: IRS. Publication 969. HSA payable to an estate is included on the decedent's final return, which means the tax lands on the person who died. Their last return, their final act with money is a bill. So on this one account, there are 3 completely different outcomes, and the only thing separating them is a name: spouse, and everything continues untouched. a person other than a spouse, and it becomes taxable income to them in a single year. Nobody at all, and it becomes taxable on the final return of the person who saved it. Same money, same account. 3 different endings, decided by a line on a form most people filled out and never looked at again. And that is exactly why I built the thing I am about to tell you about. Because Clarice did nothing wrong. She did not gamble, she did not overspend. She saved carefully for 15 years, and she filled out a form the way any loving mother would. Nobody at that bank told her that the name on the line changes the tax treatment of everything inside the account. Nobody ever does. That sentence is not printed anywhere she would have found it. That is what the Quiet Rules is. It is the drawer version of everything I cover on this channel. Written large, written simple. Which form governs which account? Which names cause which outcome? The exact questions to ask each institution, and the order to call them in. So the person sitting at a kitchen table with a folder of statements knows what to check today. Not after a funeral, when nothing can be changed by anyone. The paper remembers for you. That is the entire point of paper. You can find it at kevinexplains.shop. The link is right below this video, or scan the QR code on your screen right now. It is also in the pinned comment at the top. And there is a 7-day guarantee, always. If it does not hand you something you did not have before, you send it back. Because the alternative is a son opening a tax notice in the same month he cleaned out his mother's closet. If nobody has ever told you that a form can outrank your will, do me one favor, subscribe and turn on the bell. Because this channel reads the fine print that nobody mails to your house. Form 3. And this one is different from the other 4 in a way that should frighten you. It cannot be changed later. The pension survivor election. If you have a traditional pension, and fewer people do every year, then at the moment you retired you were handed a choice. Option 1. A single life payment. A larger check every month for as long as you live. And on the day you die it stops. Completely. Forever. Option 2. A joint and survivor payment. A smaller check every month, and when you die, your spouse keeps receiving a portion of it for the rest of their life. The difference between those 2 checks can look small on paper, a couple $100s a month, sometimes less, and that is exactly what makes it so dangerous. Because the choice is presented like a preference, and it is not a preference. It is a bet on which of you dies first. Now, federal law does protect married people here, and I want to give the law credit where it is due. For most private pensions, the default is the survivor option. To take the larger single life check instead, your spouse has to sign a waiver, notarized, verified card, source, ERISA qualified joint and survivor annuity rules, and spousal waiver requirement. But think about what that waiver actually looks like in real life. It is 1 page in a stack of retirement paperwork. It arrives during the most disorienting financial week of a person's life, and a notary is watching, so the room feels official and rushed at the same time. The spouse signs. Almost everybody signs. Because the person they trust most in the world just told them this is the better option. Roland retired from a utility company after 34 years. He lived outside Chillicothe, Ohio. He was 62, he was healthy, his father had lived to 91, and he had every reason to believe he would too. The single life option paid about $300 a month more. $300 a month. Over what he assumed would be 30 years of retirement. He ran the numbers on a legal pad. He showed Lavonne, his wife of 39 years. He explained it carefully, and he was not being reckless. He genuinely believed it was the better deal for both of them. Lavonne signed the waiver. The notary stamped it. They went to lunch. Roland died of a heart attack at 71, and on the day he died, the pension stopped. Not reduced. Stopped. Lavonne was 69. She is likely to live into her late 80s. The math that had looked so reasonable on a legal pad delivered 9 years of an extra $300 a month, and then removed a full pension check for what could be 20 years. Every month for the rest of her life, a check that used to arrive does not. And there is no form for this. There is no appeal. There is no window. Once pension payments begin, that election is generally locked permanently. Verified card. Source. Pension survivor elections are generally irrevocable once benefit payments commence. Confirm plan-specific rules. Of the 5 forms in this video, 4 can be changed this afternoon with a phone call. This one cannot be changed at all. So if you are watching this and you have not retired yet, or you know somebody who has that election in front of them right now, This is the single most consequential financial signature of a working life. Not the mortgage, not the car, this one. And if the election is already made, and it was made the way Roland made it, there is still something to do. Not to undo it, but to build around it. Life insurance sized to what the survivor loses. A plan that acknowledges the whole rather than pretending it is not there. The worst version of this is the one where nobody ever runs the number, and the survivor discovers it the same week as the funeral. And I want to give you the question that would have saved Lavonne, because it is one sentence. Not, which option pays more? That was the question Roland asked, and it had a clear answer, and the clear answer was wrong. The question is, if you die at 71 instead of 91, what does my monthly income become? That question forces the arithmetic into the open. It stops the conversation from being about the size of a check and makes it about the length of a life nobody can predict. Roland would have answered it honestly. He was an honest man. He simply never asked it, because the paperwork was not designed to make him ask it. And if you are the spouse in this situation, watching this, understand something clearly. That waiver is yours to refuse. You are not being difficult. You are not doubting the person you love. You are the only person in that room whose future depends entirely on which box gets checked. And the law gave you that signature specifically so you could use it. If you do not understand it, do not sign it that day. There is no rule anywhere requiring you to sign in the same appointment. Take it home. Read it at your own table. Form 4, life insurance, and the 2 mistakes that live inside it. The first mistake is the same one that took Ardith's inheritance, a stale name. Life insurance policies live a very long time, 30 years, 40. People buy them young when the beneficiary decision feels obvious and then never look again. Marriages end, people remarry, children grow up, people pass away, and the form does not know about any of it. An insurer does not read your obituary. It does not check a divorce decree. It does not ask your family what happened over the intervening decades. It reads a name and it writes a check. The second mistake is the one nobody sees coming, and it hurts the people it was meant to help. Naming a minor child directly. It feels like the most protective thing in the world. Your grandson is 8. You name him so that if anything happens, he is taken care of. Here is what actually happens. An insurance company cannot hand a large check to an 8-year-old, so the money goes to a court-supervised arrangement, a guardianship of the property, with filings and accountings and often an attorney, all paid out of the child's money. Verified card. Source. Insurers generally cannot pay life insurance proceeds directly to a minor. Court-supervised arrangements are typically required. And there is a second half most people never hear. On the day that child turns 18, whatever remains is handed to them, all of it, in a lump sum, with no conditions on it at all, not at 25, not for college, not held for a house. 18, full amount, their decision entirely. And I want to be honest, because most 18-year-olds are decent people who would try their best. That is not the point. The point is that no 18-year-old on earth has ever been handed a large sum of money and had the experience to know what to do with it. You did not at 18. Neither did I. The money was meant to carry that child through decades. Handed over in one piece on a birthday, it very often does not last 2 years. And the person who wanted to protect them is not there to say a word about it. But Booker learned this from the wrong side of it. Booker is 76 from Pine Bluff, Arkansas, and he named his granddaughter directly on a policy after her father, his son, passed away young. He wanted her protected. It was the most loving thing he could think to do. But what he did not know is that his good intention had built a court file with her name on it, and a lump sum landing on a birthday. The fix would have taken one conversation with an attorney, a small trust for her benefit, named as the beneficiary instead of the child herself, with instructions about how and when it would be used. Not expensive, not complicated, but it requires knowing to ask. And there is one more version of this mistake, and it is the most common of all, naming your estate as the beneficiary. People do this thinking it is tidy. Everything in one pile, distributed by the will. What it actually does is take money that would have passed instantly, privately, and free of probate, and drag it into probate, where it becomes public, delayed, and in many cases reachable by creditors. Verified card. Source. Proceeds payable to an estate generally become part of the probate estate and may be subject to claims of creditors. Life insurance paid to a named person is one of the fastest, cleanest transfers in American law. Paid to an estate, it becomes one of the slowest. Same policy, same money, same family. One word on the form decides which of those two things happens. And since I mentioned it, let me explain one phrase because it costs nothing and protects generations. Most forms let you write 2 words next to a beneficiary's name. Per stirpes. It means if this person dies before I do, their share goes to their children. Verified card. Source. Per stirpes designations direct a deceased beneficiary's share to their descendants. Without it, the default on most forms is the opposite. If one of your 3 children passes away before you, that child's share is usually divided among the surviving 2, which means your grandchildren, the children of the child you lost, receive nothing at all. Think about that outcome in a real family. The branch that suffered the loss is the branch that gets cut out. Nobody chooses that. Nobody would ever choose that. It happens because 2 words were not written on a line, and because nobody at any institution has ever explained what that line does. Ask for it by name. Per stirpes. It takes 10 seconds to add, and it can hold a family together for 2 generations. And that is exactly what the Quiet Rules holds. Which names to use and which to never use. Why a trust belongs on the form instead of a child's name. What per stirpes means, and when writing those 2 words protects your grandchildren from being disinherited by accident. For this, and for every rule in this video, sitting in the drawer, in plain English, while every one of these forms can still be changed. You can find it at kevinexplains.shop. The link is in the description and in the pinned comment at the top, or scan the QR code on your screen right now. 7-day guarantee, no questions asked, because the alternative is a widow like Lavonne, running numbers she was never shown, in a month when nobody should be running numbers at all. And if you want me to look at your own situation directly, email me. The address is on your screen and in the description below. I read every one. Form 5. And this one is not a wrong name. It is a blank line. Almost every beneficiary form has 2 sections, primary and contingent. Primary is who gets it. Contingent is who gets it if the primary is already gone. And a truly enormous number of people fill in the first line and leave the second one empty. Now think about the arithmetic of a long marriage. You named your husband as primary. Sensible. Correct. But if he passes first, and you never update the form, and the contingent line is blank, then on the day you die, that account has no living beneficiary at all. And when there is no living beneficiary named, the account generally falls to your estate by default. Verified card. Source. Where no valid beneficiary survives, retirement account default provisions typically direct proceeds to the estate, which sounds harmless. It is not harmless. For a retirement account, it is close to the worst outcome available. Because when a real person inherits a retirement account, they get a set of rules built for people, generally a 10-year window to draw it down, with room to plan the timing. Verified card. Source. Secure Act 10-year rule for most designated beneficiaries. An estate is not a person, so the account loses those rules and falls to a much harsher schedule. Depending on the circumstances, the entire balance may have to come out in as little as 5 years. Verified card. Source. Retirement accounts payable to an estate are subject to less favorable distribution schedules than those with a designated beneficiary. Confirm current rules. Squeeze the same money into half the time, and every dollar of it stacks higher on somebody's tax return. Plus probate. Plus the delay. Plus, in many cases, exposure to creditors that would not have existed if a name had simply been on the second line. That is a blank line costing a family tens of thousands of dollars. A blank line. Not a wrong choice, not a bad decision, just an empty space nobody thought to fill. And there is a second version of this that catches even careful people. Some households do name a contingent. They name their children together as a group. Then one of those children passes away, or gets divorced, or has children of their own, or the family grows in ways nobody imagined when the form was filled out in the 90s. The form does not update itself for any of that. It is a photograph of a family taken decades ago, and it will be honored as though nothing in that photograph ever changed. So this is not a task you do once and cross off forever. Every marriage, every divorce, every birth, every death, every rollover from one company to another is a moment when a form quietly falls out of date. The rollover especially. When an account moves from one institution to another, the beneficiary does not always travel with it, and a great many people assume it did. Now let me talk about the date on the thumbnail, because I owe you the truth about it. There is no law changing in January of 2027 that touches these 5 forms. I am not going to pretend there is. The deadline in this video is a different kind of deadline, and it is harder than any date Congress ever printed. Every other mistake I cover on this channel has a remedy. A missed deduction can be amended, a frozen account can be argued, a wrong tax form can be corrected, even a lost benefit can often be reclaimed. These 5 forms are the exception. The moment you die, all 5 of them freeze permanently. Not become difficult, freeze. There is no appeal, no correction, no hardship request, no phone number your family can call. Verified card. Source. Beneficiary designations become fixed at death and generally cannot be altered by the estate or heirs. Every video I have ever made, there is somebody in the audience who thinks, I will get to that after the holidays. For everything else I cover, that is fine. Late is expensive. Late is not fatal. Here, late is the whole thing. Here, late means a stranger in another state opens an envelope she was not expecting, and your wife of 31 years never gets $1. That is why the date is on the thumbnail. Not because January changes a law. Because for some of the people watching this, and there is absolutely no way to know which ones, these forms will already be frozen by then. Now let me show you the arithmetic, because I want you to see what these 5 forms are worth together. Take one household, not a wealthy one, an ordinary one. The health savings account left to a child instead of handled correctly, roughly $17,000 in tax that never had to exist. The retirement account with no contingent beneficiary falling to an estate, the compressed payout schedule plus probate costs, roughly $20,000. A life insurance policy paid into a court arrangement for a minor, roughly $5,000 in fees and supervision. A pension survivor election made wrong, and even a single year of a lost check runs about $10,000. Add those together and you are past $50,000. $52,000 in the household I just described. And I have not even counted the 5th one, the stale name, because there is no way to put a number on Ardith's account. Her loss was not a percentage. It was the entire thing. Every dollar of that came from paperwork, not from bad investing, not from overspending, not from bad luck or a bad market, from 5 forms in a drawer with the wrong names on them. Now, what to actually do. And this is not a checklist for the year, this is one afternoon. Start with a list. Every account that has a beneficiary on it. The retirement accounts, everyone from every job you ever had. The IRAs, the life insurance, including any small policy from an old employer, the health savings account, the annuities, the pension. Most households find more of these than they expect. The old ones are the dangerous ones. Then call each one and ask a single question. Not, do you have my beneficiary? Ask, please tell me the exact primary and contingent beneficiaries currently on file for this account. Exact, currently, on file. Because what you remember signing and what is in their system are 2 different things, and only one of them will be read the day it matters. Get it in writing. A confirmation letter, a statement, a screen you can print. And keep those confirmations together in one place with the rest of your papers. Not because the institution will lose them, because your family will need to know these accounts exist at all. An account nobody knows about is its own kind of loss. Every state in this country is holding unclaimed money that belonged to somebody's parent, sitting there because no one ever knew to ask. A phone call where somebody says, "You're all set," is not a record. When this is wrong, it is wrong forever, and nobody will be able to ask you what you meant. Fill in every contingent line, every single one. That blank space is the cheapest mistake on this entire list to fix, and one of the most expensive to leave. If any beneficiary on any account is a minor child or grandchild, stop and talk to an attorney before you leave that name in place. One conversation. It is the difference between a gift and a court file. And if you have a pension election that has not been made yet, or someone you love is holding those papers right now, do not let that signature happen in a hurry. That is the one that cannot be undone. Now let me leave you with the thing I most want you to keep. Every family in this video was a good family. Wilbur was not cruel. Clarice was not careless. Roland was not selfish. He thought he was being generous. Booker was doing the single most loving thing he could think of for a little girl who had lost her father. Not one of them made a bad decision. They made a fast decision. Once. On a form. Years before it mattered. That is what makes these 5 different from everything else on this channel. There is no villain here. No agency taking anything. No bank freezing anything. No collector at the door. Just paper, doing exactly what it was told to do, long after everyone forgot what it was told. And that is why this one is so easy to put off. There is no letter arriving, no deadline printed anywhere, no agency writing to you. Nothing about today feels urgent, because nothing about this is ever urgent until the single moment when it is far too late. Every other subject on this channel has a warning shot, a notice, a bill, a phone call, something that tells you the clock has started. This one has no warning shot at all. It is completely silent right up until the day it is final. Your will is the document you thought about. These 5 are the documents that will actually be read. Go find out what they say. This week. While every one of them can still be changed by the only person who is allowed to change them. You. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.